Welcome to Chit Chat Stocks, the podcast where we help you discover your next great investment. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. We have a number of big topics to get to this week. Google/Alphabet reported earnings, Tesla reported earnings with an interesting conference call, a lot of forward-looking, hopeful statements, I would maybe say. Chipotle looks like it could be at the beginning of the end, apparently, based on some comp sales figures. So we're going to analyze whether or not that seems to be a dying brand. Philip Morris, the world's largest tobacco company, we're going to be talking about them as well. And then we got a lot of questions on home builders. So we're going to get to all of that and more in a sec. But before we do, I want to mention a couple quick housekeeping items. If you are a listener to this show, please give us a rating, review. It always helps us grow. We do these episodes live on Thursdays at 5 p.m. Eastern time. So if you want to tune in, ask us some questions, head on over to YouTube, look up Chit Chat Stocks at 5 o'clock Eastern time on Thursdays, and you can ask us any questions. I'm sure we'll get some in the chat today. But that's going to do it for housekeeping items. Where do we want to start, Brett? There's and meme stocks are back.
Ryan, I have a very important question for you. Are you buying, and you don't have to answer this because you could get in trouble at home. Are you buying American Eagle?
Oh boy. Well,
Don't answer that. I'll answer that. I'll answer that for you. I'm not joking. I almost bought some. It would have worked. I tried to stay reasonable, rational, logical with my investments, and it turns out if you just had a hunch on a new advertisement, it would have made a 20% gain in one day.
Okay, it's up 20% today. I actually haven't checked.
I think if you include yesterday, yeah.
Wow. And to give some context to all the listeners out there, American Eagle recently partnered with a notable actress who has been, shall we say, popular as of late. Sydney Sweeney.
I think people know what we're referring to. If not, they can look up American Eagle. It'll be the first thing that pops up. Yeah. Honestly, I just thought in this environment with the meme stocks back, it would have been such an easy investment. But hey, look, we'll just keep in boring old stocks, earning nothing. Yeah.
There are a couple of other meme stocks, which I think we should get to at some point in this episode, but maybe we start with some real topics here. Where do you want to start? Tesla earnings or Alphabet?
Let's do Alphabet. It's such an important company. You made some notes on here. Cloud doing phenomenally well. The AI threat, the AI potential. I mean, it's just one of these that's turned into such a battleground stock. And as you're going to go through here, the financials have not been affected and have probably been helped by AI so far.
Yeah, there's a lot to unpack every time Google reports earnings because there's like 4 or 5 huge businesses under the hood there that are like some of the biggest digital businesses in the world. So I guess let's start with search. Google search revenue grew double digits. I believe it was 12%. I should probably have that pulled up, but double digits. There was just since basically the rise of ChatGPT, there has been sort of a simple thesis of conversational AI is taking share, so Google search is dead, which means Google is dead. That's kind of been, I guess, the skeptics look at it. And it's pretty easy to go down that path. Like you use conversational AI for the first time or maybe a couple times, and you start to realize you're replacing some of your own search queries that you would be using Google for with ChatGPT or with a conversational AI. And all of a sudden you think, wow, Google search is screwed. We are not seeing that play out in the numbers yet. So far, not only is Google search revenue growing, but the number of paid clicks continues to grow as well. I believe it grew 4% this quarter, which is actually up. It's an acceleration from last quarter. And there was some really interesting commentary. This is the primary battleground area of Google is the search business. And it's because it accounts for more than 50% of revenue still. But all the commentary from Sundar Pichai and the management team has been, well, obviously they want it to be really positive, but it's hard to read their comments and be too cynical about the business. So here's a quote from the conference call. He said, "Overall queries and commercial queries on search continue to grow year over year. We are also seeing that our AI features cause users to search more as they learn that search can meet more of their needs. That's especially true for younger users." So they actually, it sounds like, have some internal data that shows that a lot of the people that are using AI are increasing their query volume. So it, it seems they seem to believe that it's like accretive basically to search, that it's not cannibalizing them, it's just adding new search queries. There's probably some level of cannibalization there, but I'm going to leave that for a second. We can hold that discussion. Second big segment for them is YouTube. YouTube ads grew double digits, and interesting quote here as well. It says, in the US, shorts now earn as much revenue per watch hour as traditional streaming on YouTube, which I guess it requires going through a lot more shorts than just watching a normal stream. But it's amazing how quickly they close the gap on that, because I think they launched shorts, I want to say about 2 years ago. For them to be able to kind of close the monetization gap there, I find that pretty impressive. And then the third segment here, and I'm saving kind of the best for last in this case, is subscriptions. This is not the best one. This is, I would say, well, it might be one of the best ones. Subscriptions are also growing double digits on a percentage basis. I believe they were up 20% year over year. And that is being driven primarily by YouTube subscriptions, is what they said. And then Google One. So YouTube, I find this, I really wish they would break out YouTube subscription revenue, because you've got a massive subscription business now. I want to say $50 billion in revenue in Google subscriptions. And they're saying it's primarily being driven by YouTube. And then you have another nearly $40 billion in ad revenue on an annual basis from YouTube. I'm curious. I would be so curious to see how much in combined revenue and profits they're generated from YouTube overall, because it just seems to be one of the most durable digital businesses in the world right now, and flexible. They've adapted to other, uh, not computing platforms, but consumption platforms really well in terms of streaming TV, mobile, desktop. They've really been able to evolve.
I think the revenue, I've said this before, but I think the revenue would impress people and the earnings would disappoint. Margins, there's a lot of revenue that gets paid out to the creators, the YouTube TV stuff that's extremely low margin. So that's about my take, but still a good business. And what's weird though is you look at this $50 billion in revenue, give or take, for YouTube, maybe a little bit more now. It's pretty irrelevant to the stock, especially if you think that the margins are going to be much lower than Google search. And as you're about to get into, Google Cloud as it's gaining scale.
Yeah, this was by far the standout part of the quarter for me, and it's becoming an increasingly important piece of the sort of Google puzzle. So maybe a month ago, I think it was about a month ago, someone asked me, it might have been you, if I am more or less optimistic about Google than when I started my position. So I started a Google position, I want to say like 6 months ago. I've added a little bit here and there, but it's not a huge piece of my portfolio. But I mentioned how a lot of the developers were reacting positively to Gemini 2.5. And that seemed like maybe not the biggest deal at the time, but now it's really starting to show up in the financials. So this earnings report gave us a lot of clarity on just how much of an AI winner Google is on the development side. A month ago at some conference, I think it was their Google I/O conference, Google reported that 7 million developers were building on top of Gemini's API. That was up from 5x from the year prior. So I'm assuming that's basically a year ago, 1 to 2 million developers were. And then this quarter, a month after their I/O conference, they said 9 million developers are. So they've gone from 1 to 2 million developers building on top of Gemini to 9 million in a little over a year. And when we look at Google Cloud's it's not just the revenue growth, but if you and shout out to Fiscal AI for this because they made it really easy. Google Cloud surpassed $50 billion in annual recurring revenue this quarter. And the quarterly ARR growth was well above any quarter in their history. They added $5.5 billion in annual recurring revenue for Google Cloud this quarter alone. And let me actually pull up the backlog figures because this kind of blew my mind. And they're actually not that far off, I don't believe, from AWS's backlog figure. At least, basically, I think backlog's a little closer to AWS than the revenue is. Anyway, I'm going through a lot of numbers here. They went from $92 billion in Google Cloud's backlog to $108 billion quarter over quarter. So sequentially, they added $16 billion roughly in backlog. The there are so many businesses truly building on top of Gemini now that I think this can become a really big business for Google. So here's a quote from Sundar Pichai. We operate the leading global network of AI optimized data centers and cloud regions. We also offer the industry's widest range of TPUs and GPUs, along with storage and software built on top. That's why nearly all Gen AI unicorns use Google Cloud. I on honestly, I think within 5 years, $100 billion in Google Cloud revenue is achievable.
Definitely, 100%. What are we at? We're at 50 now, right? So double in 5 years, easy. Honestly, much more, I'd say. You have the other
Yeah.
numbers here. I'll let you take a breath. $85 billion in capex increase, $10 billion from last report. I think people were a little bit worried about that, but honestly, with Alphabet compared to someone like Meta or Microsoft, I guess can make money off it pretty easily, but especially with Alphabet because they have both the consumer side and the infrastructure side, I would be bullish. It would be bullish to see more capex, at least for me, because not only do you have this cloud revenue that can, and now they're making money, 20% operating margin on it. Now you have this cloud revenue that can, you get a good return, get a good ROI, and all this capex coming in. You have the Gemini consumer app, and I'm not sure if they calculate the monthly active users with the people that use the API or the development tools as part of their monthly active user count. But according to the conference call they have, the Gemini app now has 450 million monthly active users. That is catching up to OpenAI and ChatGPT. ChatGPT is still bigger, but pretty impressive coming from a standing start just a couple of years ago and fumbling at the start when they had all these name changes. The stuff didn't work very well. They were putting all the pieces together. Unlike when, who would it be? Zuckerberg claiming that Meta AI has a billion users. I actually believe this number because it's not accidentally clicking it on WhatsApp or Instagram. And the fact that you have these $20 subscriptions that you pay for, I pay for it. I think it's quite valuable. You have the bundle with Google One. Gemini not only sorry, with AI, Google Cloud will not only, as you mentioned, probably get $100 billion in revenue, if not much more within the next decade. They are going to see through advertising on Google search with you mentioned the AI overviews and then the subscription revenue with Gemini probably eventually adds on the free tier there. There are so many ways they can monetize that compared to anyone else, they're just separating themselves from the pack within this AI race. And I don't want to call it. It's not over because there could be some innovations and something could come out of the blue and disruptions and all that good stuff. It's pretty unpredictable. But if you had to make a bet today, if they were going to say who's going to win the AI race and Vegas put out odds, I think now Alphabet would be a favorite. Like
Yeah, which
minus
is shocking given the valuation relative to the other tech
or the
companies.
narrative.
Yeah,
The
yeah, the
narrative a year
narrative.
ago. Yeah. Well,
So
when Google
to
search dies, let me know. It hasn't yet.
right. To put some numbers on this, here's the I'm gonna pull up a chart here that really stands out to me. So this is quarterly growth in cloud ARR versus quarterly growth in CapEx. maybe I can stack this here so it's easier. Basically what I'm trying to say here is they are increasing CapEx because they're booking it in revenue. It's not like this hopeful thing where I think with Meta and, well, maybe not so much Microsoft, but really definitely Meta, you see a lot of this CapEx spend or this CapEx estimates, I guess, as not like a clear direction. Like, okay, they're going to produce Llama 4. How accretive is that going to be to revenue?
Now, how are
I'm
they gonna
not
monetize that? Yeah,
right.
Meta's the only other one that's vertically integrated, but so, for example, what I mean by that is OpenAI has to spend money on some other cloud service in order to get revenue. It just makes it way, way harder to be profitable and generate positive cash flow. Meta does have this vertical integration where they're both building the infrastructure and trying to monetize it themselves, but I don't know, and I think you're about to mention that the path to monetization is so much less clear than Alphabet.
Right. Yeah, okay, so Alphabet increased their CapEx by $5.2 billion this quarter, and all the big tech companies are increasing their CapEx really quickly on a quarter-over-quarter basis, but they're doing this. They increased CapEx 5.2, they increased cloud ARR by 5.5. So, like, you're already seeing a revenue jump directly from it, and they are increasing it because there is demand for AI compute services, Gemini's products, and they're capacity constrained. And they keep talking about that. They're very capacity constrained. There's a huge lock in when you're on uh, running various services on foundation models. So when Gemini's core to what you do, and you have various processes throughout the company that are using Gemini's reasoning or detection models, you don't want to really rip and replace that frequently. So this is the ARR growth, but there's really high lifetime value to locking in some of these businesses. And they talked about signing some huge, more than $1 billion contracts for Google Cloud alone with single customers this quarter. It just seems like you hear all this talk about them being an AI loser, and under the hood, they're powering most of these Gen AI businesses. Like,
Yep.
I they
Yeah, I
are a
agree.
winner under the hood, but just no one seems to be giving them credit. I just 17 times forward EBIT, I really think this is like a 2-foot hurdle here.
I saw one of the large customers could have been ServiceNow. I think I saw that. Not sure if that's confirmed or not. Not sure if they're switching from another provider because I assume they were with someone else before that. But they signed $1 billion deal with ServiceNow. Stock is only up 1% today, Ryan. Are you buying more? Are you shocked that it's not up more?
Yeah, on the numbers, I'm pretty surprised that the stock didn't jump more than it did. I think the one thing that demonstrates where they are at in the AI stack, like if you want to compare all the companies, how and where they're at in terms of like AI capabilities. OpenAI just became a huge customer for Google Cloud using, I assume, some sort of Gemini
Right.
product. Like,
Microsoft seems to be in a just ruined its starting position with their relationship with OpenAI, and that's really all they had within AI. And now it's maybe going away entirely. I wouldn't want to be Microsoft. Ryan, well, not you're not gonna actually do this, but gun to your head, long Alphabet, short Microsoft, and Apple. Would you do it as a pair trade? Do you think that works?
I have a hard time shorting Microsoft.
Well, no, I'm saying just the difference. You take the shorting money, like so it just has to Google just has to or Alphabet just has to outperform Microsoft and Apple
Oh,
by a good amount, right? Pair
yeah.
trade.
Yeah, I would take that. Apple for
Why
sure.
do you think, and I guess you're as perplexed as me, why do you think Apple and Microsoft keep trading at higher multiples?
I honestly do not know. I would say like some sort of indexing thing, but that doesn't, Google's in the index just as much as they are. So it's not like passive flows are dominating for Apple.
Yeah.
It, it doesn't make a lot of sense to me. Maybe there's just a sense that Google is in a more fragile position. I think that's kind of the general sense with like people that aren't really looking at Google that closely, where they feel that, okay, Google search is in a little bit of a fragile spot. The moat's not as wide as owning the the iPhone or owning the operating system. But then you look what all these services are really running on under the hood, and Google's the back end. So maybe it's just like they just think the moat is wider, but I would probably disagree.
Yeah, I disagree as well. I should have bought in April on the dip. Was thinking about it. It's been on the watch list. Wish I was a shareholder, but to Ryan and all the other listeners that are likely shareholders, congrats on the solid returns. And I think it's going to be another strong year, unless, of course, they're tied to consumer spending. So if consumer spending collapses, hey, replay this clip. Stock is probably going to be down. Anything else before we move on? We got a lot of other topics.
No, the only other the big risk that I see here is that advertising spend slows like across the board, and people see it as Google search decreasing specifically. Like cuz
Mm,
like Google
yeah,
search could decline just purely cuz the advertising cycle turns, but people would be like, "Well, this is the beginning of the end." Like, look, see, the search revenue's down, but really it could just be an advertising cyclicality.
that's a good point. Okay. Want to talk Philip Morris? This is one that we cover a lot. You trimmed, I believe, but still own some.
I cut my position by about 60%.
Nice, good timing on that. Not
Well,
got,
now I'm wishing I sold all of it.
yeah. I guess I got. Well, we're back to, let's see, what was the stock finish at? 161. Hey, we're back to about the price I sold on Liberation Day. So hasn't worked out that or well for me. Uh, what happened here, Ryan? You made the notes. Seems like people were simply looking at a slowdown in Zyn growth, nicotine pouches growth, and forecasting that to the future of what them losing market share to Velo, British American Tobacco, and it's not going to be a winner takes all space.
Yeah, that really seems to be the focus is like Zyn versus competitors, but Zyn still is not that big of a piece of the business. IQOS is bigger, which is their other smoke-free product, heat not burn technology, and then cigarettes is still the largest portion of the business. And both those segments are doing really well. Zyn had its first sequential volume decline in I want to say like 3 or 4 years, which to be clear, there are supply chain related issues with that. And maybe there's some seasonality to Zyn consumption. I wouldn't really think so, but could be. So on a year over year basis, it looks really good. I think that Zyn volumes grew like 41% year over year. But they did decline significantly compared to last quarter. Here's my thing. So I guess let me go through some of the numbers and let me forget that it's Philip Morris. Uh, just imagine this is a consumer packaged goods company. 7% revenue growth, 15% operating income growth, 19% earnings per share growth. They raised their full year guidance. And those were all above expectations. That sounds pretty good for a consumer
Now,
packaged goods company.
let me give you next 12 months earnings. PE 20, 21, EV to EBITDA 16. That feels fair value for a company like that if you understood that they have an enterprise value of $300 billion. So I feel like we're back to kind of a fair price. Stock's up 67% this year. It's not like shareholders are dying.
No, it just goes to show that if you have a company trading at a premium valuation, you not only need good results, but you need s- such good results that they surprise to the upside. So, like,
Yep.
not just beating estimates, but kind of reassessing estimates altogether. And you didn't really get that this quarter. You did get that last quarter because there was that huge uh the, initially there was a big uh supply chain like backup essentially. Like they weren't able to fill all the orders they wanted for Zen. And then they did it all last quarter. There was a huge jump in volumes, and now we've seen it kind of turn back. The rest of the business is doing really well. Combustibles is growing, revenue slightly. Volumes, I think, are down like 1% year over year. But
Yeah, they forecast global declines because they're ex-US, so US is growing or declining much faster, about 2% volume declines in a normal environment. And you can monetize that pretty consistently with price increases. They should see currency adjusted single digit revenue growth from that business. It's very, very predictable. I think it just comes down to expectations investing. Expectations got a bit out of hand. Flight to safety, maybe, especially because they're diversified from the dollar and some of the stuff that's been impacting portfolios so far in 2025. And expectations got too high, but it's still a good business. Now, what price would you add to your position? Because I was trying to think about this during this drawdown. I kind of think the 130, 140 range is where I feel like forward returns look, especially if they turn on the buyback, really strong again.
yeah, I'd say if it gets to a low teens, like 12 to 13 times forward uh EV to EBIT, which is just sort of that's usually the metric I use for most of my valuations, unless there's some deep flaw in the the IT in there, which is interest and taxes, but usually that's encapsulated in the enterprise value. 13 times I'd probably add. I think they're probably at what, like you said, 17, 18.
Yeah, it will, EBITDA was 16 next 12 months. So yeah, I'd assume it's in between the PE and the EV to EBIT. Yeah. So decent drop from here, but definitely doable. And it's still I still think a great business. What do we
Yeah,
want to talk about
it's a
now?
bummer. I wish I had sold more, but
Hey, a couple weeks ago I was kicking myself for selling it all. So things can happen quickly in financial markets.
true.
What about all right, dealer's choice, Ryan? Open Door or Tesla?
Let's talk Open Door.
Okay, I had not thought of this stock for about 2 years. I honestly thought it was headed for bankruptcy. It looks like investors believe that too. It was trading at just 50 cents a share about a month ago or sometime in July. And yet it's up 370% in the last month because it seems to be a specific target for meme stock hype. Without saying who this person is, there's a hedge fund manager on Twitter who has been on CNBC and Bloomberg, so they don't care if someone is talking about what they're doing. They're doing this all publicly, so it's not like I just don't want to give them any publicity by sharing their actual name. This investor has gotten increasingly vocal about the stock, saying it is the next Carvana. And remember, Carvana came back from the dead and has been, I think, 100 bagger since the lows at the start of 2023. And this investor is calling for the stock to hit $82 a share, open door stock, uh, by this year, I think. So that would be a 100 bagger from the lows. And this is full sarcasm for the listeners. I think this is definitely fundamentals, right? And not because there's a massive short interest in open door stock and trying to drive all of the traders on Wall Street and trying to do a whole roaring kitty thing. Here are some quotes from tweets just this morning. If open shareholders focus all our energy on buying and holding our stock and calls, if that's your lane, the reflexivity kicks in. The re-rate will be violent. We're talking Cisco.com levels of upside as the turnaround clicks. Strap in believers and haters. $82 is coming. Ryan, are you a believer or are you a hater in Open Door?
I am a
You have to
hater.
choose one side.
I'm a hater. This okay,
It's a bad business, isn't it? It's just a bad
right.
business.
So look, I'm not If you want to buy it because it's a meme stock, whatever, that's fine.
We want everyone to make money, but we also don't want people to lose money.
I am still a believer that you should look at stocks for the businesses that are behind them. And I just think Open Door is what a horrendous business model. Like okay, maybe this is a cigar butt. Maybe it was doomed for bankruptcy and there was some value there. That's how I think meme stocks tend to start. Like GameStop was that they had like a 20% dividend yield and it looked like they were going to cover. It starts as a value play and all of a sudden it turns into a meme stock. The But the business model here is so bad. It's so bad.
Yeah, way
You are
worse. It's not
buying
necessarily It's not like the industry's dying. It's not like residential real estate purchases are dead. This is a really bad business model. It's like you invented a business model that was worse than individual home flippers because you can't lock in 30-year fixed rate mortgages. You're taking bad loans out, you're loading up your balance sheet with residential real estate inventory, and then you're trying to flip it for a higher cost. It is so tough, and it's such a bad business model, it's actually laughable.
think
Now
about
or
think
go ahead, man.
about think about this from your own personal view. Listeners, if you have a house, think about the stuff with your house that might be a little wrong, that there's something wrong with it. Maybe there's like issues with the foundation, there's some repairs that need to be done, whatever. Would you the whole game here is margin of safety. So they're offering like they're spraying and praying with low ball offers. If you have a good house, you're not going to take the low ball offer. Like and most people are not like, I got to get out of this yesterday. Like I'm going to take whatever offer I can get when it comes to a huge, like a home. So the people that are accepting the offers, I don't think that's the supply that Open Door really wants. And my guess is they have drastically, on a recurring basis, drastically underestimated the spend that's needed to improve some of these homes. Now, I saw a whole bunch of things on forums, Reddit forums, like, oh, I got unbelievable. I've never expected to get an offer this high. Open Door is the only
Yeah.
one that gave me this offer. Like that, you cannot imagine worse commentary for your business model. The fact that everyone got out of this so quick, Zillow, I think Redfin got into it too, got out pretty quick, just goes to show that they probably saw the cracks in this business model. And it's not like, oh, this business is more resilient because they stuck around. It's like they didn't have any alternative.
Ryan, ignore all this. Imagine if all of the force of retail and institutional took the energy of Wall Street bets and focused it on buying and holding all possible shares and options of one stock with a genuine turnaround story. Open Door. There's another quote from this hedge fund manager. I think the odds on Kalshi or what is the other one called Polymarket about an SEC investigation into this Twitter account, whoever actually owns it, is high. It's high. Those odds are rising. You can because this type of stuff, it I guess was made legal for crypto for whatever reason. You can pump and dump, but this is pure pump and dump, is it not? Am I seeing this in wide open, just in front of everyone's faces?
Now, speaking of pump and dump, there's never been a
Alleged,
better
alleged.
time to buy Google. We should, I'm just kidding. The, it's, yeah, it makes, of course, it's unethical. I'm not sure on the rules. I assume that's against the law,
Pump and dumps are
honestly.
supposed to be illegal. Crypto was made legal for God knows why, but I guess you have to technically, like, lie, pop it up, and then we don't know if he's done the dumping part. Do you know well, you see my notes in front of me. The listeners, maybe try to guess in your head how much, and I just used the fiscal AI for this, was quite helpful. Just pull up the chart, add everything together. How much in cumulative cash flow has Opendoor lost since 2017? Drum roll, $5.2 billion. Market cap today. Wait, let me pull it up because it could be trading wildly. 1.7 billion. It is lost so much money. If I mean the business model just got worse and worse as it got bigger. It's had to shrink. There's no way that it's an impossible business model.
You know
I
what I
can't
hear,
even find
Brett?
the words to describe it. There's no proper way to say how bad this business model is.
I hear when you say 5.2 billion in cash lost, all I hear is deferred tax assets, hidden
Yeah, that
value.
is true. That is true. Yeah. Yeah. Yeah, they might have some good net loss carry forwards that someone would want to acquire. That's fair. That is fair. Maybe that's the bold thesis. What about Tesla?
Let's do it. I saw a hilarious tweet that wasn't meant to be a hilarious tweet from what's his name? The Bloomberg character on Twitter, Walter Bloomberg.
Oh, yeah, yeah.
Let me pull it up. This wasn't, it was my favorite thing is that he tweets everything so matter of factly, like he doesn't
Yeah,
have
it's
any
just
opinions.
headline aggregation from
Right.
Bloomberg. Yeah.
It's just headline aggregation. Now, let me pull up. Oh, wow. I can't pull it up. Okay. I'm not sure what's happening here. Twitter.
Twitter down on you?
No. Okay. I got it. Wait. Tesla reports Q2 free cash flow of $146 million. Estimate $760 million.
Yeah,
That's
that's tough.
that
I
can't
don't
be
even know how
good.
you'd estimate that.
Yeah.
Um,
It's got to be a tough thing to estimate, but it's just a hilarious headline. So, why don't you go through some of the numbers? There was some uh, maybe it was slightly better than some people expected. I'll raise my hand and say I was expecting a little bit worse, honestly, but go through some of the headline numbers.
yeah, and maybe before any of the listeners say, yes, we are forgetting the Tesla diner in Los Angeles, part of the growth story, I know. When they open
Have
one in
you
Austin, I expect Ryan to go.
have you
But
updated your DCF?
yeah, I will update the DCF. Honestly, that is a decent business idea, especially with the charging kind of problems. It's just kind of funny the way they brand it. All right. Here's a quote from this is the first line of the press release. Q2 2025 was a seminal point in Tesla's history. The beginning of our transition from leading the electric vehicle and renewable energy industries to also become a leader in AI, robotics, and related services. The related services, diners. But I'm curious to know why they're leading in AI, but XAI is getting all the funding to for Grok and all of Musk's endeavors. That's kind of a different story. But I think this narrative that they're building is very key for investors to look at because they are telling you that they are pivoting away from the traditional car business and renewable energy because, well, these businesses are either stalled out or collapsing. Auto revenue is down 16% year over year. Energy generation revenue down 7%, even if those supposed to be a major growth engine for this business. Operating margin in the quarter of just 4.1%, heading into a period where tax credits on EVs are going to expire. So that's going to get even worse. I think in 2024, they had $2.4 billion in tax EV credits. Cumulatively, since I think 2016, they've had $11 billion. That makes up a huge portion of their net earnings. Free cash flow, as Ryan mentioned, was pretty flat. And they do have $37 billion in cash. I will. This might seem like a dumb question, but if with the EV credits gone, the fact that their unit figures around the globe and basically any forward-looking indicator for the automotive business looks like it's going to start burning a lot of cash quickly with no new models coming online and the Cybertruck being a total flop. They have $37 billion in cash. Is that going to be enough? I'm serious. This could turn ugly really fast, especially if they're quote unquote investing in AI. What do you
Yeah,
think, Ryan?
I'm sharing this total automotive gross profit chart here, and it's down. Well, let's just check from its high in December 2022. So in December 2022, they were generating $20 billion in annual gross profit from their auto business.
These are
Today,
last 12-month figures.
yeah,
Okay.
today they're generating 12.5 billion in automotive gross profit. So gross profits for their car business, which You can call auto a car, or sorry, you can call Tesla a car company or not. It's up to you how you want to categorize it. But currently, the lion's share of their of their revenue and income comes from selling cars. It's down almost 40% from the highs, and they're going to be losing one of their highest margin assets, I guess you will, in the EV, or sorry, in the tax credits, regulatory
Yep,
credits.
2.5 billion of that 12 billion is about to get wiped out.
So it's hard to imagine this part, the auto business, not seeing more pressure on the gross profit side. Now, there was a lot of talk in the conference call
Oh,
about.
you actually listened? You took the time for that, Ryan? That's a sacrifice.
I will say I hesitated. I I was thinking about whether or not to read it. I started. It was a little tough to read because
You're sacrificing for the listeners, and I appreciate it.
yes, honestly, it's exactly what I did. I did not want to read it. I have no interest in a company, long or short, and I knew we were going to talk about it on the conference or on today's podcast. So I read. I tried to read the conference call. If you are skeptical about some of the accounting and the hopeful statements that come out during these, they are very hard to read. It's very frustrating. This call was no exception. There's a lot of talk about full self driving and the value unlock there. But what I don't understand, first off, for a long time, full self driving was the call option on the business. That was the hidden upside. It was like this could be the biggest value unlock as soon as all these cars can drive themselves and people have to pay for it. It's like just 100% profitable to deliver this software. Now it's the only thing holding this up. Like if they don't get full self-driving available for their entire fleet, I don't see how they generate enough cash to warrant the valuation. So it's not become a nice thing anymore. Now it's a necessity. And it's all they talked about on the call. Yet what I don't understand is for them to roll this out, they have to do it the way Waymo did. They have
Yeah,
to do
expensive.
yes, which they got to build custom cars for this with lidar technology on them. It's not like they're just going to license it out to their existing fleet. That's not what's going to happen. So
Yeah.
maybe I'm wrong. Maybe that's still somehow possible, but that doesn't seem to be the case in terms like if you look at what they're doing in Austin, that's not the case. It's not like they have some random guy's Tesla going around doing these FSD rides. It's a custom built car for this. That is expensive to build out. That takes time. You need regulatory approval. And he said this was the most outrageous part to me. He believes they will be serving half the US population by the end of the year.
Wait, what? No, that's not happening. That's not happening.
Yeah, he said the full self-driving rides will be serving
Oh my
half
gosh.
the US population by the end of the year. And then he did his classic, assuming we can get regulatory approval. He
Yeah.
said it's up to the regulators.
Well,
Well,
yeah, of course. You get the whole if you get the whole population if it wasn't up to the regulators.
yeah, it just it's Groundhog Day. Like we have heard this
Yeah,
so many
true.
times. End of the year, it's gonna come. There, I
Lord.
would that would might be one of his most outrageous claims so far is somehow turning this to half the population in 6 months seems unlikely.
I 100% agree. Stock was down 8% today. Down 20% this year, but up 40% in the last year. I will disclose full disclosure. I'm short a whole two shares. So just to get that out of the way, I don't want anyone to not know that that's listening. I am biased. I think the stock is vastly overvalued, but it is a minuscule part of my portfolio.
What companies are you short?
Palantir, Tesla, and this makes up less than 10% of say net, so it's a small part overall. Most of the times people have much larger short books. The nuclear I don't want to use a swear word. The nuclear pure plays that are pre-revenue, the electric air taxis, and quantum stocks. I kind of have some of those
Wow.
pre-revenue ones. Yeah.
Didn't know you'd been expanding your short book so much. Well,
But remember, these are like the sizing is tiny. I don't want to get caught up in making one short position like a Tesla or something like that. 10% of my book. It's tiny. I want to be very diversified. That seems to be the way that works out best for most people. I don't have to worry about something, even if it goes up 300%, crushing my returns. That actually happened to one of the nuclear stocks, and you barely even notice. So, yeah,
yeah, having a huge short position just seems like stressful.
risky, stressful. Yeah.
Okay, Chipotle. Is Chipotle a dying brand?
Ryan, can I pat myself on the back? I've been early on this last 5 years, but
Well,
I would have been wrong so far. I was about 200% ago on the stock.
you, yeah, early. You may have been a little too early, but now your gripes came from quality, food
Yeah,
quality.
I think that could be impacting. That could be impacting the numbers.
Let's go through some of these numbers. Gonna pull up fiscal AI real quick. The number that popped out to me more than anything else, and probably is the one everyone needs to pay attention to, comp store sales declined 4% this compared to last year. That is the worst comp store sales growth they have seen since the pandemic. And if you strip out uh, June 2020, so you strip out the pandemic impact, that's the worst they've seen, I assume, since the E. coli crisis. Now, the
Did they have any
I
excuses for this? I didn't
um
have time to read the call.
let me give it a peek here. Let's read the press release, shall we? Shall we?
All right.
We are seeing momentum build as we rolled out our summer marketing initiatives as our comparisons ease. Our
Oh,
talented restaurant
what?
teams.
Sorry, it's so funny.
Yeah, I love this is one of my favorite things in corporate speak is when people talk about how the forward growth is going to be better because we had bad results recently. Like we're having bad results now, so it's going to be easier to surpass them in the future. That's
Yeah.
the bull thesis. No, it says our talented restaurant teams remain focused on delivering handcrafted meals. Let's see if he actually gives anything useful. I am optimistic that our positive momentum will continue as we further. Nope, not useful, not useful at all.
This is negative momentum.
Yeah.
They're
Comp
just
sales decreased 4%.
margin down. I remember seeing that.
Yeah, I mean, margins have to come down if you're right.
Especially even with inflation. I pulled up the call. Actually, was able. There's another free advertisement for Fiscal AI. The was able to pull up the call and search through it for comparable sales, and they said, considering the ongoing volatility in our trends in the consumer environment, and we now anticipate comparable sales to be about flat for the full year. And then blah blah blah. We have a strong plan. So comp sales flat for the year is their guide. I don't know if I can have a full take on Chipotle yet. I want to see how they compare to other restaurants. If every restaurant is doing terribly, then hey, maybe Chipotle's okay. But last quarter, they saw a huge decel. They have a further decel this quarter, and some other brands were doing just fine. I can't remember what Domino's posted, but I think Domino's was just fine. So I think this might be a Chipotle level issue.
Domino's comps were positive. So the thing here is props to Brian Nickel, former CEO of Chipotle. He left Chipotle at absolutely the right time. And also, he's now like might be one of the top fast casual restaurant food CEOs in the world because his timing was impeccable. And he also sold, I believe, all of his shares after he left Chipotle. So he started
Wow.
unloading pretty quickly.
Well, they had a stock
And
split. They had the CFO leave and the CEO leave. That's good timing if you're ever gonna get out of a company. It would have been good timing to sell.
and he joined Starbucks, which I I personally think could be turning the corner to growth again. And it just good for him. Honestly, good for him. When he felt like the valuation on Chipotle and maybe the concept was getting towards saturation, to move to something that's, I would argue, is stickier in terms of customer retention, coffee. It's stickier, less competitive, and more advantaged. Maybe I'd
Yeah,
give him
I
some
heard people
brand
saying
advantage.
we're ending the age of Chipotle. We're entering the age of Cava. Could be true. Could be true. Do they have those in Austin?
Kava,
Yeah,
probably
probably. They don't have them in Seattle. Um, do you want to guess what Chipotle's price to earnings ratio is?
25.
Stock 41.
Really?
Yeah. What a great short opportunity when the CEO left. It was the PE was like 60.
I mean, restaurants are tough, honestly. I
Minimal
think,
operating leverage.
well, yeah, I mean, running a restaurant's tough, but it just, I don't know. When you hit saturation, it feels like it's almost like retail a bit, where consumer habits can change unless you have like a really big advantage in being like a low cost provider, like Domino's, I think is the low price provider, and it's sort of a self reinforcing
Yeah.
competitive advantage there.
And their input cost, bread, tomatoes, cheese, a lot better than meat for
Yeah,
cost wise.
it yeah, it's got to be difficult to be the one that steps into the CEO suite there, replaces Brian Niccol at an all time high valuation. Do we want to talk home builders? We got some questions
We did, yeah.
from listeners.
People wanted to cover this. Um, I guess yeah. This is kind of shout out to the not. I guess we don't talk with them that much, but we've met them before. Friends at Value After Hours that do their veggies every week. This is kind of a veggie segment. We went through the fun stuff, and now this is some. I wouldn't call it dense. I think it's interesting macroeconomic topics. So we got a few questions on home builders for when we asked what we should talk about this week. The big home builders are all at least in a 20% drawdown right now. Lennar is actually in close to a 40% drawdown, but in the last month, there's been a recovery. Stocks like Pulte Group up 10% in the last month. Yes, that is the Pulte that you're thinking of. It's the same name.
Grandson of the
Uh,
founder.
yeah, is the one, whatever job, FH, whatever, Federal Housing Administration, that tweets constantly, almost as much as the Open Door guy. Home sales revenue was down 4% for Pulte Group last quarter. They reported this week or late last week. Gross margin was down to 27% versus 30% a year ago, and backlog is steadily falling. DR Horton Homes revenue is down 7%. So we're seeing compressing margins, a little bit of decrease in home sales volume for them. Stocks all traded at PE ratios of around 10. It's kind of at a companies could be expensive, they could be cheap. You gotta ask, are earnings depressed? Will growth resume if mortgage rates fall? I kind of think, and I can share some of these charts from the calculated risk blog, that well, it might be hard for you to see. I can just describe them. But the macro indicators out there, they look to me a little bit bleak. You have rising inventories. So we have this chart here that shows new homes month of supply. So essentially what this shows is the amount of new homes on the market that compared to how many are getting sold each month. So if you have currently we're at close to 9 months of supply on the market. The higher, the worse it is for home builders because you have more, supply out there. The other times that new home months of supply hit these levels would be the Great Recession and other recessions going back to, I think, the 1960s. So it's kind of an indicator that things could be looking bad for the housing market. And then there's also another one I think is quite interesting, which is new home inventory. So this is a little bit different. It's another way. It's more of a specific way to measure inventory, and the amount completed isn't that high, at least compared to the great financial crisis, but the amount of new homes under construction are at the highest levels excluding the great financial crisis and are getting there quite quickly, going all the way back to 1973. So I think for me, these are ones I don't want to touch. They were fantastic buys. What was it when the mortgage rate spiked in, was that 2022? Something like that.
Yeah.
But I think, yeah. Yeah, I mean, D.R. Horton's still a double from there. But I think today I'm very, very nervous about these companies. If some things go wrong, there's a lot of inventory that could be out there. And if existing home sales pick back up again, that's some more supply hitting the market.
I'm a D.R. Horton shareholder. I was a little surprised by the stock's reaction to this quarter. I read through the conference call, and it's just going to be a period. It strikes me as it's probably going to be a period of just them not earning as much as they used to. I don't think it's going to be cataclysmic or detrimental to the business model, especially since they've really kind of pivoted to being so asset light, and they don't really they don't own their land for the most part. 75% of it's owned by their land bank, and then their turnover time or their inventory turns continues to come down. So they're building them quicker and selling them quicker. But the issue here is that there's just some compression on the gross margins. So this is probably going to happen across the board with all home builders. They, the reason that, what are you pulling up here? Yeah, they are buying back a ton of stock. There's an interesting quote on the conference call. Maybe you can pull up the conference call, Brett. For context, Brett's pulling up Fiscal AI here, and keyword in valuation.
Okay.
So before I get to this quote, basically gross margins were a little better than expected this quarter because they stopped pulling so much of this or offering as much incentives. From what I could tell, basically there's different levers they can pull to increase the attractiveness or encourage people to buy homes today. Like they can do mortgage rate buy downs, they can lower the price. There's just different things that they can do. They can offer uh, different stuff with the mortgage sides, especially since they're lend most of their home buyers use them for home loans as well. But they said incentives might kick up here in the summer and into the fall because they are still seeing a hard time. It's less affordable, essentially. People are having a hard time affording homes still because rates are higher. Now, with that said, the valuation has come down a lot. People are soured on this. People are worried that interest rates are going to cause a crisis, I think, frankly, for home builders. And here's what Bill Wheat, the CFO, said. He said, obviously, with where our share price has been, we feel like the valuation is attractive. And so we're taking advantage of that during this time. They are buying back 9% of their market cap in cash annually right now. I believe the buyback yield's at 9%. Assuming that earnings have plateaued, like earnings, it's not like they're at peak earnings anymore. They were at 30% gross margins. Now they're at like 23%, 24%. So we've already seen earnings collapse a little bit. If earnings can stay flat or even grow over the next 5 years, and they're buying back 9% of their stock, you honestly don't even need earnings growth for the shares to do well.
Yeah, I can understand that thesis. It's good that they're buying back a lot of stock. I think management seems smart. I look at the gross margin and we're still not back to pre-pandemic levels from a gross margin perspective. So I do think there's still risk of margin compression going forward. But I can understand the thesis. What are they at? PE of like, it's like 10, right? So you still, even if you get a compression and they start buying back and they look, if the downside stuff materializes, it's not like I don't think the stock's going to collapse or anything, but the housing market it looks like from all the forward indicators is flipping from a seller's market to a buyer's market. And we're just on the start of that.
Little anecdotal evidence here for the week. I checked out a house in the Austin area, which is always nice to go from like growing up in Seattle to like checking out houses in Austin. You always
Best housing market for buyers in the country, Austin.
feels like just so nice. Like you can just get a lot more. Anyways, but the realtor was like, honestly, just offer whatever price. Just throw out a price. And I like not to her, but like offer it to the
To the
company,
yeah.
to the home builder, and see if they might bite. Because it sounded like they are having a hard time getting rid of their inventory. Now,
That matches
that
up.
wasn't
Yeah.
D.R. Horton. I checked because I was a little concerned.
Yeah, you're making sure. Yeah, but this could be a tough period. Still, some of these are good businesses. NBR, DR Horton. My anecdotal evidence, and I guess we're going over time here, is that there are a lot more for sale signs going up. Used to be totally empty for existing home sales, and I think some people are trying to sell, but there's this whole mismatch between what they think their home is worth for what Zillow tells them what they want to sell for these existing homes versus what someone like Ryan or I's age, first time home buyer can purchase. And that's going to slowly match up. Either, I think this is unlikely, either our salaries are going to go up 50% or home prices are going to come down. I think home prices will likely come down instead. Ryan, anything else before we wrap up?
No, I think that's about it. Next week, we got more earnings. Amazon, I believe, should be out. Big tech, I believe, reports kind of next week as well. So we're going to have a lot to discuss next week. I'll be on. We'll have a replacement. We'll have a sub. Brett will be out. So we're going to have a listener favorite, John Rotanti, will be joining the show.
Yeah, make sure to tune into that. Hopefully, record viewership when I'm gone. That'll make me feel great. But no, everyone should listen to John, and he always comes with great insights, perfect timing with big tech earnings, and I'm excited to listen to that one. Okay, let's get out of here. Full disclosure: we're not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan and I or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning into these live episodes. They go 5 p.m. Eastern time on Thursdays, give or take. It could change sometimes, but you can listen to the replays on YouTube, Spotify, Apple Podcasts. They come out Friday morning. Give us any suggestions for what to talk about on Twitter, Substack, what have you. Let us know what you'd like us to talk about. If you enjoy these episodes, give us a review on Apple Podcast or Spotify. And we'll see you next time.